Have you ever wondered how the so-called experts can get it so wrong all the time? Today, we're diving into the murky waters of car stock, or Avis Budget Group, where three analysts thought they could navigate the turbulent tides of the market, but ended up capsizing instead. What unfolded is nothing short of a financial train wreck, leaving investors reeling and scratching their heads in disbelief. These analysts didn't just misread the signs, they orchestrated a masterclass in incompetence that could cost investors dearly. As we peel back the layers of their blunders, we'll expose the shocking disconnect between their glowing predictions and the harsh reality of cars' financials. Were they blinded by optimism, or were they simply too careless to notice the storm brewing on the horizon? Their egregious misjudgments not only highlight a lack of due diligence, but also raise unsettling questions about the integrity of their analyses. It's a tale that unfolds like a suspenseful thriller, where the stakes are high and the consequences even higher. But don't think we're here just to bask in their failures. No, we're here to learn. As we dig deeper into the company's fundamentals, we'll uncover the critical lessons every investor should heed. In a competitive landscape where rising operating costs can quickly erode profitability, understanding the dynamics of revenue growth is paramount. If costs outpace revenues in an industry as volatile as car rentals, it's a recipe for disaster. Join us as we unravel this complex narrative and arm you with the knowledge to avoid falling into the same traps that ensnared these analysts. The lesson today is simple. When the warning signs are flashing, don't ignore them. Your financial future depends on it. As we uncover the financial pitfalls of car stock and the critical lessons learned, let's not forget that mastering the digital landscape is equally crucial in today's world, and really fast. If you've been struggling to grow your YouTube channel or harness the power of AI to stand out, then check out Matt Parr's Tube Magic course. This cutting-edge program teaches you how to leverage AI to create compelling content and build a successful channel. By learning these strategies, you'll not only gain a competitive edge, but also become one of the few who can navigate this new era of content creation effectively. Imagine transforming your channel into a powerhouse that captivates viewers and drives engagement. With expert insights and practical tools at your disposal, now is the perfect time to invest in your future and become the envy of those still trying to figure it out. Click the link in the description to get started. As we peel back the layers of SiriusXM's financial mismanagement, a troubling pattern emerges, one that savvy investors should have seen coming. From declining profit margins to rising debt levels, the warning signs were everywhere, yet they went unnoticed by those tasked with guiding us through the murky waters of investment. What led these analysts to overlook such glaring red flags? Stay tuned until the end, as we dive deep into the chaotic mess they left behind. First up in our incompetence court is none other than Chris Waronker of Citi, who somehow managed to blow the incompetence meter off the charts with his most recent misguided predictions. How did he miss the mark so badly? Let's unravel this baffling case together. Chris stands accused of gross incompetence. He began his coverage of car back in 2015 and began with a cautious hold-buy call, but quickly changed gears to a buy call, which he held onto with slightly overbid price-chasing targets until October of 2019, when he segued into a hold. The weird thing is that he did this while it was still just about to go on its biggest bull run to date, but still not horrible, as he told them to buy when they should have. He then essentially held on to this hold status until November of 2021, right before the stock was about to explode, and decided to segue into a hold sell, which eventually changed into a sell hold, and then a bunch of overpriced hold calls, which he clung to until June of 2023. Not sure what he was smoking, but why would you tell people to hold and have a price target that is almost 50% over that actual stock price? Mind-boggling. Price targets were whack, and timing was a little off on these so far, but overall, I would argue this is not horrible, as he did at least warn investors, and he did also tell them to buy back when it was undervalued. So we don't want to be too harsh here, but what happened after this made the whole story messy for Chris. In June of 2023, Chris decided to give car a hold-buy, which soon thereafter turned into a buy-hold, and then a buy, which he maintains until this day. The court gives Chris some credit for his early buy calls, which turned out to be correct, and for advising investors to hold as the stock rose. His timing may have been a bit off, but nobody's perfect in this game. The court also acknowledges that Chris warned with sell calls around the peaks, which was solid advice. However, the buy calls near the end while the company was in a clear decline with negative fundamentals, are inexcusable. Guilty as charged. The court grants him probation due to earlier good behavior, and we hope he doesn't land in here again. Chris, you were doing well. Pick yourself back up. We believe in you. Our next defendant, Ryan Brinkman of JP Morgan, unfortunately can't claim the same streak of victories. His track record tells a different story, one where missed calls and questionable recommendations leave little room for redemption. Ryan is being held on charges of financial massacre. Ryan began his coverage of Carr in 2021. He jumped in with an air of caution in his overweight neutral call, which quickly turned into an outright neutral call. He decided to hold on to this until 2 years and change later, and throughout the biggest bull run that Carr was to ever see, at least heretofore. And then after the massive bull, as problems mounted for the company, he decided to change to ridiculously priced overweight positions, which he holds to this day. Guilty as charged. If we all bought when he said neutral and sold when he said buy, we would be rich. Sentenced to a life of unpaid manual number crunching at your nearest investment bank. Our final defendant today is a clear example of a guy who says fuck this stock without actually saying it. This is a prime example of how neutral calls often serve as euphemistic sell calls. Analysts like him rarely come out with strong sell recommendations because they're worried about damaging relationships with their biggest clients, who not coincidentally are often the very companies they're supposed to scrutinize. Instead, they dance around the issue with hold or neutral calls, leaving the real message hidden beneath the surface. Christopher Statholopoulos of Susquehanna began his coverage after the major bull run and began with a neutral call. He then held on to his neutral, essentially matching the price of the stock more or less to this day. The bull run was over, the problems were brewing, and he knew it. But did he ever explicitly warn investors with a sell call? No, he took the easy way out, playing dumb with a neutral recommendation. Why? Because it's easier. It keeps the big clients happy and requires less effort. Just slap a neutral on the stock and clock out. Unfortunately for him, that strategy doesn't fly in incompetence court. Guilty as charged, sentenced to a lifetime of having to make trades with his own money based on his professional calls. Good luck with that, Chris. Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. As we wrap up our analysis of the analysts' blunders in incompetence court, it's crucial to understand the backdrop against which these misguided recommendations unfolded. The story of Carr stock isn't just about numbers and calls. It's about a rapidly changing industry landscape and the mounting challenges that Avis Budget Group faced. To fully grasp the implications of these analysts' failures, we need to dive deeper into the company's history, its market position, and the broader economic factors at play. Understanding the environment in which Carr operates will shed light on why these analysts missed the mark so spectacularly and how their misjudgments contributed to a larger narrative of financial mismanagement. Let's explore the background of Avis Budget Group and the intricate web of factors that set the stage for this financial debacle. Avis Budget Group, a key player in the car rental industry, has faced significant challenges in recent years that have severely impacted its stock performance. Once riding high on the waves of a booming travel market, the company found itself grappling with rising operating costs, declining profit margins, and increasing debt levels. As travel restrictions lifted and demand surged, Avis failed to capitalize on the momentum. Instead, it became ensnared in a web of inefficiencies and financial mismanagement. At the heart of the problem was a dramatic escalation in operating expenses, particularly in fleet management and labor costs, which outpaced revenue growth. While the company attempted to expand its services and invest in technology, these initiatives did not translate into the expected returns, leaving a significant gap between costs and revenue. Additionally, Avis's reliance on debt financing to fuel its growth created a precarious situation. As interest rates began to rise, the burden of servicing this debt became increasingly unsustainable. further straining its financial health. Fundamentally, Avis Budget Group saw its profit margins erode as competition intensified in the car rental market, forcing the company to offer deeper discounts to attract customers. Coupled with a lack of innovation and failure to adapt to changing consumer preferences, the company struggled to maintain its market position. As the analysts failed to recognize these red flags, investors were left blindsided when the stock began to plummet, ultimately leading to significant losses. Avis Budget Group's financial woes were rooted in a combination of rising costs, inadequate revenue growth, and a high debt load. The analysts' inability to accurately assess these fundamental issues only exacerbated the situation, illustrating a glaring disconnect between market perception and financial reality. Today's lesson centers around a crucial trio that can spell disaster for any business: operating expenses, debt, and inflation. Understanding how these elements interact is vital for making sound investment decisions. First, let's talk about operating expenses. When a company's costs, such as labor, materials, and overhead, begin to rise without a corresponding increase in revenue, profit margins start to shrink. This is particularly dangerous in competitive industries where companies are pressured to maintain pricing or offer discounts just to keep customers. If a company can't manage these costs effectively, it risks undermining its financial stability. Next is debt. While leveraging debt can be a powerful strategy for growth, it becomes a double-edged sword if not handled correctly. High levels of debt increase a company's financial obligations, especially in a rising interest rate environment. When combined with rising operating expenses, this can lead to a cash flow crisis, as the company struggles to meet its obligations while trying to remain profitable. The risk compounds when the market turns and revenue slows. Suddenly, that debt can become a heavy anchor, dragging the company down. Lastly, inflation adds another layer of complexity. As the cost of goods and services rises, companies often face increased operational costs. If a business cannot pass these costs onto consumers without losing sales, its profitability suffers. To add insult to injury, inflationary periods often prompt central banks to raise interest rates in an attempt to combat rising prices. This increases the cost of borrowing, making it even harder for companies to manage their debt. The result is a vicious cycle where rising expenses, elevated debt levels, and fixed revenue streams lead to shrinking margins, exacerbating the problems caused by operational inefficiencies. In this precarious environment, it's critical for investors to recognize these interconnected risks and remain vigilant about a company's financial health. Analyzing a company's ability to manage these factors is crucial before making investment decisions. Understanding the interplay between operating expenses, debt, and inflation can help you identify red flags that may signal a company is headed for trouble. The lesson here is clear. Don't ignore the fundamentals, especially when they signal trouble. Be proactive and ensure you're not caught off guard by the perfect storm of financial mismanagement. For if you allow that to happen to you, you just may wake up one day, turn on YouTube, and see yourself sitting in the incompetence court.